Welcome to StockTok's deep dive into Boston Scientific Corp. Boston Scientific is a global medical device company that designs, manufactures, and markets a broad portfolio of medical devices used in cardiology, oncology, gastroenterology, and interventional medicine. As of May 5th, the stock is trading at $55.98. Over the past 52 weeks, it has ranged from a low of $56.05 to a high of $109.50. The Relative Strength Index, a momentum indicator that measures overbought and oversold conditions, sits at 33.1, suggesting the stock is approaching neutral territory. The 50-day moving average stands at $66.22, while the 200-day moving average is at $89.52. This positioning suggests the stock is trading below both its intermediate and longer-term trend lines. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Boston Scientific operates across four main therapeutic areas: cardiology, which includes rhythm management and structural heart devices; oncology and specialty interventional solutions; gastroenterology, focused on endoscopy equipment; and urology and pelvic health. The company's competitive moat rests on proprietary technology, long-term customer relationships with hospitals and clinics, and significant switching costs. Once a hospital deploys Boston Scientific equipment into its operating rooms and cath labs, the costs and complexity of switching to a competitor rise substantially. The company also benefits from regulatory barriers to entry in the form of FDA approvals and international certifications that take years to obtain. On our StokTok scoring system, Boston Scientific receives a 65 out of 100 overall score, rated as a buy. This breaks down into 5 dimensions. Valuation scores 10 out of 20, suggesting the stock may be trading above its intrinsic value. Financial health scores 15 out of 20, indicating adequate but not fortress-like strength. Profitability scores 15 out of 20, meaning margins are healthy but not exceptional. Growth scores 17 out of 20, pointing to solid expansion. And smart money scores 8 out of 20, showing limited enthusiasm from the largest institutional investors. Now, valuation. The question every investor has to answer: are you paying the right price? Boston Scientific trades at a price-to-earnings ratio, or PE ratio, of 23.44 times trailing 12-month earnings. This is a moderate multiple, not cheap, not expensive, but in line with a quality healthcare device manufacturer. When we examine the forward PE ratio, which projects the next 12 months of earnings, we see a significantly lower valuation of 16.59 times. This discount suggests the market expects earnings to grow meaningfully. The PEG ratio, which divides the PE ratio by expected earnings growth, sits at 0.75. A PEG below 1.0 is generally viewed as attractive, indicating that growth prospects justify the current valuation. The enterprise value to EBITDA multiple, a measure of the total cost to acquire the company relative to its operating cash generation, stands at 16.82 times. This is middle of the road for the healthcare devices sector. The price-to-sales ratio, which divides market capitalization by annual revenue, is 4.03 times. Our proprietary DCF, or discounted cash flow model, which values a company based on the present value of its future free cash flows, suggests the stock is trading at a 9.18% premium to our calculated intrinsic value. This indicates limited margin of safety. Wall Street's view is notably more optimistic. 32 analysts cover Boston Scientific, with a consensus mean price target of $85 per share. The high target reaches $110, while the low sits at $60. This suggests analysts see nearly 50% upside from current levels, though the spread between high and low targets is wide, reflecting genuine disagreement about the company's fundamental value. Turning to the latest earnings results in Q2 2025, Boston Scientific reported earnings per share of $0.75, beating the analyst estimate of $0.73 by 2 cents. Revenue came in at $20.61 billion, matching the consensus estimate precisely. After hours, trading saw a modest positive reaction, with the stock moving up approximately 0.5%. This was a solid but not spectacular quarter, a beat on the bottom line that reaffirmed guidance but offered no major surprises. In the context of broader market sentiment, we note that the landscape around Boston Scientific leans substantially bearish. Multiple securities class action lawsuits and fraud allegations have dominated headlines and weighed on investor confidence. This negative sentiment substantially outweighs positive commentary from a handful of billionaire investors and Wall Street analysts, creating a risk-reward setup where downside sentiment may provide some buffer to further declines. On valuation alone, based on what we see, Boston Scientific does not appear deeply discounted. The forward PE of 16.6 times and PEG of 0.75 suggest reasonable value for a consistent operator with mid-teens growth. But the 9% premium to DCF fair value and the ongoing legal headwinds suggest caution. Moving to financial strength, how solid is the foundation? We begin with the Piotroski F-score, a 9-point checklist developed by accounting professor Joseph Piotroski that assesses the financial health of a company by examining profitability, operating efficiency, leverage, liquidity, and source of earnings quality. Boston Scientific scores 7 out of 9, which is solidly above the median, and indicates a fundamentally healthy balance sheet with mostly positive indicators. The Altman Z score, an academic model that predicts bankruptcy risk by combining 5 financial ratios, comes in at 3.64. Scores above 2.99 are considered in the safe zone, so Boston Scientific sits comfortably in low bankruptcy risk territory. Examining the debt structure, Boston Scientific carries a cash-to-debt ratio of 0.17, meaning cash on the balance sheet covers only 17% of total debt. This indicates the company is leveraged, though not excessively so. The debt-to-equity ratio stands at 0.47, which is moderate and in line with industrial and healthcare peer averages. More importantly, the company's interest coverage ratio, which measures how many times operating income can cover interest expense, reaches 11.5 times. This is very strong. It means Boston Scientific generates operating profits sufficient to cover its interest payments more than 11 times over, leaving ample cushion for operations and dividends. The current ratio, which divides current assets by current liabilities to measure short-term liquidity, comes in at 1.62. This is healthy and well above the 1.0 minimum, indicating the company can comfortably meet near-term obligations. In our view, Boston Scientific's balance sheet is fundamentally sound. The company has adequate leverage, strong interest coverage, and solid short-term liquidity. The Piotroski score of 7 and Altman Z of 3.64 confirm this is not a company in financial distress. However, the leverage position, with debt to equity at 0.47 and cash coverage at only 17% of debt, means the company has limited dry powder for major acquisitions or to weather severe business disruptions. Management has demonstrated disciplined capital allocation over time, but the balance sheet is not fortress-like. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, or return on invested capital. Boston Scientific delivers 10.66%, which represents the profit the company generates on every dollar of capital, debt, and equity that management deploys. For context, a return on invested capital above 10% is viewed as healthy and competitive, suggesting the company is creating value for shareholders. A return on invested capital below the company's cost of capital would indicate value destruction. At 10.66%, Boston Scientific sits just above the threshold, implying reasonable but not exceptional capital efficiency. Moving through the margin stack, gross margin stands at 69.16%. This is strong and reflects the pricing power Boston Scientific enjoys in its medical device markets. Hospitals depend on these products, and the company's brand, regulatory certifications, and customer relationships support premium pricing. Operating margin, which reflects profit after accounting for selling, general, and administrative expenses, reaches 19.92%. This is respectable for a scaled device manufacturer and indicates the company's core operations are profitable. Net margin, the bottom line profit after all expenses and taxes, sits at 17.29%. This suggests Boston Scientific converts roughly 17 cents of every revenue dollar into net income, which is solid. Free cash flow margin, the percentage of revenue that converts to cash available to shareholders after capital expenditures, is 16%. This is strong and indicates the company's earnings quality is high. It is not just booking accounting profits, but generating real cash. In the context of the latest quarter, these margins reflect a business in good operational health. The Q2 earnings beat on a relatively flat revenue result suggests the company continues to wring efficiency gains from its existing asset base. Our take is that Boston Scientific's profitability metrics are healthy. The 19.92% operating margin and 17.29% net margin indicate good operational leverage. However, the return on invested capital of 10.66%, while above the cost of capital threshold, is not exceptional and suggests limited margin for error. Management must continue to drive efficiency or face compression. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years averages 16.5% annually. This is solid and well ahead of broad market GDP growth or even most healthcare sector peers. Over the past 5 years, growth has moderated to 13% annually, indicating some deceleration but still respectable expansion. The company's book value, the accounting value of shareholder equity, has grown at 10% over the past 3 years. This is in line with net income growth and the company's retention of earnings, suggesting management is building shareholder value through reinvestment. Boston Scientific currently pays no dividend, with dividend yield at 0%. This indicates all profits are being reinvested into the business for acquisitions, research and development, or debt reduction. In the context of the latest quarter results, the matched estimate on revenue growth suggests the company is tracking to the mid-range of expectations. Management has not provided quantified forward guidance, but analyst consensus for the next earnings period in late July estimates earnings per share of $0.83, suggesting 6 to 7% sequential quarterly earnings growth at the high end of typical seasonality. The deceleration from the 3-year average of 16.5% to the 5-year average of 13% warrants attention. This may reflect the company's scale. It is harder to grow fast when you are a $100 billion enterprise, or it may signal headwinds in key end markets. The data suggests growth is still respectable, but may be facing maturation pressure over time. Boston Scientific is not a high-growth story, but it is a consistent expander with revenues climbing in the mid-teens over the past 3 years. Now let's talk smart money. What institutional capital is actually doing with this name? 19 top-tier investment gurus, as tracked by Dataroma's database of 36 of the world's largest value investors, currently hold Boston Scientific in their portfolios. This is a solid show of confidence from the most sophisticated investors globally. However, examining the direction of their moves reveals a mixed picture. John Armitage of Edgerton Capital, one of the largest value managers in the world, holds Boston Scientific at 5.58% of his portfolio and increased his position by 1.37%, signaling conviction. Lee Ainsley of Maverick Capital, another multi-billion-dollar manager, holds a 3.02% position and is a net buyer. Stephen Mandel of Lone Pine Capital, with a smaller 0.14% stake, is also buying. These 3 top managers are clearly accumulating. However, on the reduction side, Poland Capital Management, with a 1.64% portfolio weight, cut its position by a dramatic 28.2%. Viking Global Investors reduced its stake by 4.99%. These reductions, particularly Poland's sharp cut, suggests some of the largest holders are trimming exposure, perhaps due to the legal headwinds and negative sentiment we noted earlier. Looking at the broader institutional picture, 9.6% of all 13F institutional filers, that is, investors managing over $100 million who report their holdings, are net buyers of Boston Scientific, with more than 50% ownership thresholds indicating bullish positioning. This is below our preferred 50% threshold for strongly bullish positioning. Insider ownership is extremely low at 0.75%, meaning Boston Scientific's own executives and board members own minimal stakes in the company. This is a red flag in our view. When management owns very little, they have limited skin in the game and less alignment with shareholder interests. Over the past 3 months, there have been 0 insider buys and 0 insider sells, suggesting management is inactive or indifferent to valuation at current levels. In our interpretation, the smart money picture is decidedly mixed. Several prominent value investors are buyers and accumulating, which is bullish. However, the sharp reduction by Poland Capital, the below-threshold 13F buying percentage, and the complete lack of insider activity all suggest skepticism about the current setup. The legal challenges and negative news flow appear to be deterring some otherwise interested capital. And finally, the verdict. Let's bring it all together. On valuation, Boston Scientific trades at a moderate multiple with forward PE of 16.6 times and PEG of 0.75, suggesting the growth prospect justify the current price, though our DCF model suggests a modest premium to intrinsic value of 9%. On financial strength, the company's balance sheet is fundamentally sound with Piotroski score of 7 and Altman Z of 3.64, but leverage is moderate and provides limited dry powder. On profitability, margins are healthy, 19.92% operating and 17.29% net, though return on invested capital at 10.66% is merely adequate. On growth, Boston Scientific is delivering solid mid-teens expansion over the trailing 3 years, though 5-year growth has decelerated to 13%, warranting attention to maturation. On smart money, several top value investors are actively accumulating, but significant positions have been trimmed, and insider activity remains flat, suggesting institutional skepticism. The latest earnings in Q2 2025 beat estimates on earnings per share, but matched revenue expectations, offering modest validation of the business model, but no major catalyst. Taken together, Boston Scientific presents as a fairly valued, moderately growing, profitable medical device manufacturer facing near-term legal and reputational headwinds that have dampened institutional enthusiasm. One might argue the case for a patient accumulation at levels closer to the $40 to $50 range, where margin of safety would be more compelling. At $56, the setup looks interesting to us only for investors with specific healthcare thematic conviction and multi-year time horizon tolerance for litigation resolution. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Boston Scientific Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.